interesting possibilities this week. So it's about 3 hours before market open, so plenty of time to prepare. And let me tell you how I've decided to prepare. Are you ready? So, I have a list of possible short squeezes. Now, the orange ones are near and soon to be, like BLNK or FUV, but I would say there is a bit of a possible inconsistency between these two. So let me show you what I mean by that. Inconsistency in the case of timeline, not in the squeeze itself. So how did I even find these? Well, in the previous videos that I've sent out, I've shown all the details on how I particularly hunt down and scalp these short squeezes. But let me give you a little overview on Blink and FUV, as they are the ones that I believe are going to squeeze very soon. Potentially this week, more than likely next week. Okay, let's just get Ortex to play nice with, I think, Chrome. Chrome seems to be a little bit of a hassle for the Ortex software. Come on. Come on, you $600 piece of software. Let's go. Great. It's definitely Chrome. Let me, oh Jesus, my whole, okay, I just have too many Chrome windows open. Let's start that from scratch, shall we? Brand new spanking window. No thanks. I don't want to crash again. So programming also helps me. Oh, what am I doing? With the crashing ability, because I leave tabs open on so many forums to get information on some bugs. And I end up leaving those tabs open, which causes my whole computer to just burp pretty bad. Now, let me just check. Volume is up. Yes, my volume this time is indeed up and running. I have that issue too many times already. Come on. Jeez. Alright, so here's my 2 picks for this week. BLNK, FUV. What's the difference? So, let's see if you can find it. Okay. I'll be a little bit clearer though, and I'll show you where the inconsistencies are. Not inconsistencies, but rather timeline dependencies. So we expect some pretty hefty squeezes from these. Why? Well, if we take a look at the squeeze information, well, we have 20 million shares that need to be bought back. If we take a look at the failure to delivers, we've got a pretty big amount of millions, right? 5 million here, 5 million here, 7, no, that's exchange reported. Where's the FTDs? 5 million here, 3 million here, 600 million, 600,000, 2.5 million, etc. Right? So we see not only is there a high 50% of the free float short interest, but there's a lot of FTDs that need to be covered as well. That does not guarantee the short squeeze. However, the things that actually make the short squeeze are twofold. First, community support. You need people to buy and hodl. Second, you need the hedge funds to be bleeding. This is the current utilization of all the possible short loaned shares. How many are there available to borrow and sell? Well, in this case, there's 0 available. The actual utilization is 100%, meaning that there are literally no shares available to borrow in order to short sell further. Well, oh, that's not fair. This was the key here. So it's being updated right now, but I did also post this on my Discord. So what is the key for the actual short squeeze? It's the cost to borrow. How much does it cost to borrow? So here's my comparison here. This is for BLNK. Before the update, we had 24% cost to borrow. That means you are paying 24% of the shares you are borrowing currently. So per share, per short. Now, of course, we do have an A right now because the data is being updated. So given enough time, we'll see what the data is, potentially within the next hour, if I'm still streaming by then. But that's 24% for our BLNK, but the minimum is still breathable, right? So the minimum is actually 0.35%, which honestly, they can survive with that. So this is why I believe Blink is not going to actually squeeze this week, maybe next week. I need to see the cost to borrow minimum go above 10 or 20% just to get the ball rolling, right? We can kind of follow the CBT max to see when a possible increase of shorts will begin on, of course, coordination with the utilization being 100%. Think of it this way. Utilization is how much of the total possible short available shares are being currently used. And it's a supply and demand factor. If there are not many shares available, but there is a lot of demand to borrow shares, well, they're going to find the shares to borrow, but it's going to cost a heavy price because there's not a lot available. So the supply and demand concept works all throughout the market, literally the basis of how a market works and functions. But when we actually have 100% being the case of a completely full utilization, you are going to start seeing the cost to borrow increase. Hence our 24% over here. Hence the possible starting to increase of the 0.39. Now what I've noticed is these do increase. However, they increase in a specific way. First, not only in FUV do I see a much higher potential here. Their cost to borrow max is about 40%. Their cost to borrow minimum has already jumped to 20%. However, I noticed when the minimum jumped, the utilization fell, which does not mean that they returned anything. This means that they found more shares to be borrowed. However, those shares are not cheap, right? There's probably a warehouse of shares just ready to be borrowed by somebody for a short sell. But not all of them, or at least by risk management, you wouldn't go beyond maybe 70-80% of the total shares, and you'd keep like a 10-20% buffer space for emergencies potential, right? At least through risk management, there's some sort of system like this. So if the utilization goes down while the cost to borrow goes up, that means that they are using from that extra emergency warehouse of loanable shares, right? Which will, of course, cost more to borrow because those are emergency funds. If somebody needs to tap into something that's highly emergency related, like think of your Roth IRA, right? Some of these retirement funds, they don't let you touch your money until retirement, hence retirement fund. But if you do decide to, there's a hefty fee to take money out. I don't remember how much, but there's also tax on top. But I'm going to guess somewhere around 30-40% of what you take out will be the fee. So in this case, these are loanable shares. There's not a lot available. They do still have some. However, if we touch those shares, we're going to have to increase the cost to borrow. And when the company is desperate to short and try to manipulate the stock down by selling, by overcoming supply and demand, by flooding the market with supply, with a low demand, then you're going to get a price decrease, right? If you have a higher supply than demand, price decrease. If you have more demand but low supply, price increase. If there's any lesson to be learned here from high school, it's the supply and demand. If you kind of mold that into your thought process when you're thinking about anything related to stocks, that supply and demand is the key mover of prices, of interest, of volume. I mean, just about any aspect can use the supply and demand concept. And that's why I assume it was taught to us back in high school as we doodled the super bad superhero penises on our papers, right? So I can't be the only one that doodled. So the case scenario is FUV has a higher cost to borrow minimum, which tells me that it's primed to start increasing further. Yes, the utilization is less, but I remember seeing the utilization was 100% when the cost to borrow was maybe 1%. Now they're digging deep into extra shares, bringing down the utilization because they've introduced new possible available shares. However, those shares come at a cost of a higher cost to borrow. So when do stocks squeeze? Question mark. Well, it really is the case of the CTB, how much it costs to borrow a specific share, right? The higher the cost and the lower the tolerance of these institutions that are borrowing and paying the cost to borrow. For instance, huge institutions, well, they can probably get away with a couple of days of 200%, but eventually they're going to start bleeding hard, and their risk management is going to say, hey, it's going to cost us less to just buy these shares than if we kept holding on to them, right? And at that moment, when it costs more money to hold the share than it would to actually release the share back into the wild, right? By buying that share, covering your short, and then closing out that position, if it becomes more economically, more efficient in the form of value, right? Risk management value, if it becomes a better risk or a lower risk to just buy the share instead of keep paying the CTB, no matter how stubborn these institutions are, they're going to cover because they're paying more on a higher risk, low reward, while they could be at least doing a low risk, lower casualty. That's the key. And how do I know? Well, let's look at SPRT, the most recent explosion. Maybe it's still, maybe it has an NA also. Yeah, NA. Of course, I keep track of all this stuff in my Discord. So anytime you guys decide, if you're in my Discord, there's a lot of information in here. Anything from keeping track of the total market to the crypto market to specific stocks. So where was my data for SPRT? I think it was this. No, it's still AMC. I thought I kept track of it. I didn't mention it a few times, but I didn't go. This SPRT honestly was a last minute fight for me. I did give some info though. Oh, it's FUV again. Alright, well, essentially, yeah. SPRT did have about a 300-400% short interest, or sorry, cost to borrow. So in the comparison of what it used to have, right, maybe 10-20%, it jumped pretty quickly. And when it runs up to a max, probably around 300 or above percent, and a minimum of 100 or more percent, I feel 99% confident that it will squeeze within the next week. If we see a CBT minimum of 100% and a CBT maximum of 300-400%, right? The minimum is the most important part, because what's the minimum mean? It means that there's some brokers out there, market makers, that are just loaning out shares for a very cheap interest because they're probably involved in these shorts and they want to hold on as much as they can, which means that some of them can make their own rules, right? So that's the minimum, them making their own rules. Eventually, though, they cannot keep holding down on a low cost to borrow. That timeline I've kind of estimated to be about 130 to 160 days, depending on the stock. Each stock has its own particular timeline. So if I look at something particularly like FUV and I say, hey, I see that the interest is going up. I see that the possible squeeze is due. What about that timeline factor? Right now we're at 208 days. So this one was a little bit different, but notice from this spike to this spike was less. So it's not a perfect concept. I would say the first possible squeeze, let's see. Yeah, I would say the first possible squeeze was right in this area. So from here to here, so from squeeze to squeeze, this one has about a 216-day squeeze potential. This here might not actually be a squeeze. So remember, FOMO. FOMO can do some damage. Not only FOMO, but also the options chain. I think this was that option chain. There's no way you're going to go from 93 cents to $9 if it was not a squeeze, right? This is $6 to 20. That's a 3 times multiplier versus a 10 times multiplier. Anything above a 5 times multiplier in price growth is, I would say, qualified to be a minimum squeeze. If you go up to 10 time multiples, you're looking at a pretty big squeeze. If you go up to 20, 30, 40, 50 time multiples, you're looking at the mother of all squeezes, right? We're looking at AMC and GME for those. However, this here I will not consider a squeeze. This was FOMO and option chains. This, however, was a nice squeeze from the 90 cents to the basically $9. This is a 10 time multiple. So this was the squeeze and it ended here. But in order to find the squeeze to squeeze potential, that's about 213 days. Where are we currently sitting? Oh, well, we're currently sitting at about 206 days. So we're looking at about 210, 220 days before we get our squeeze on. Because, of course, you got to give a little bit of buffer space, right? But not only is the timeline starting to play very, very nicely. What else is playing nicely? Well, we just went over it. Well, kind of, right? It's an NA at the moment. But we saw it in the screenshot before. That we are getting a good response from the cost to borrow. Cost to borrow is increasing in the minimum. So not only is the timeline getting close by about 10, 20 days before we squeeze, it's playing a great kind of cooperative pattern with our cost to borrow at 18%. Now, BLNK is about 0.3%. That's chump change. This is someone making rolls and doing the bare minimum available to short something. Probably some big exchange like Citadel. But if we look at, let's say, BLNK, what's the squeeze potential in the timeline here? Well, I will constitute this as a squeeze from $1 to 14. That's a 14 time multiplier. But I will not constitute this as a squeeze from 10 to 30 because that's only a 3 times. That's the, again, FOMO and option chain increase, right? I wouldn't, would I even, that's 18 to here. I don't even know if I'd constitute that as a squeeze. That one's a little tricky because at least in the FUV, we had a huge 10 to 30. That's still 4 times. Maybe I'll have to readjust my multipliers. Maybe anything around 2 to 3 is FOMO and 3 and above is squeeze. Of course, I'm still playing with the data as I analyze all these companies, right? But if we look at BLNK, we do have that initial squeeze from $1 up to 8 and then up to 14. Then we have this FOMO possibility. But then again, $6 to 34. That's the low. I can see a good squeeze happening there. So let's say that this was a squeeze. This was FOMO. So from squeeze to squeeze, we have about 139 days here. And then squeeze to squeeze, 66. I don't even think that's a squeeze. What's another 140? This would be a squeeze from 24 to 45. But again, the strength of the squeeze is all dependent on how much the actual shares are in loan. I don't think Blink is going to be a huge squeeze. Neither do I think FUV is going to be a huge squeeze. We're looking at the strength of a squeeze related to the number of shares on loan. Keep that in mind. The timeline of the squeeze is based on the cost to borrow. So we have, or we need, a huge amount of shares on loan. Right now it's only 20 million. And you're saying, oh, only 20 million? That's still a lot. Yeah, but there's stocks with way more. And even if I consider Blink as a possible big short squeeze, I would have to look at the fail to deliver to see if there are if there is extra ammo in the background, right? Now, as for BLNK, yeah, we've got 11 million here. Got 5, 5, 5. I'd say about an estimate of about 50 million. So that's actually a good set of fail to delivers. But these fail to delivers are not directly related to a timeline. That's the problem. The current shares on loan are the ones being cost to borrow, that you're paying money to borrow. These are fail to delivers, which means they've been stored in the warehouse somewhere waiting to be returned. They have to be returned. But question mark on the time. So maybe we can get a pretty big squeeze with the current shares on loan. And then in order to cover all the FTDs, they could go through the fail to deliver chain and just cover all like 50, 60 million. Then we're going to see another 7 to 10 time multiplier. But if they only cover the 20 and they leave that fail to deliver still in the background, based on the patterns that I've seen so far, I can see maybe a 3-time multiplier, which, come on, 300% in a couple of days. If you play your cards right, you can use these pieces of detail to kind of optimize your squeezes, right? So personally, I see Blink solid resistance or solid support here. I'm buying here. I've already bought my no, I have not bought my Blink. I bought my FUV because I think that one's gonna go first. But I would say this is a good buy opportunity. I'm probably gonna buy a couple. Maybe, I don't know. I mean, this is honestly, a Blink is a long-term hold, to be completely honest. So, I mean, it's a good company, is what I'm trying to say. Arkimoto, also a good company, better than, let's say, other squeeze potentials. But long-term, good company. Short-term, we got to take a look at those option chains again. Not option chains, the short chain. From the current shares on loan, 11 million. Okay, that's all right. To the fail to delivers, which is 3 million. 3 million. Okay, so they got about maybe 20 million here. So I can tell you by that already, Blink is going to have a bigger squeeze. We'll see how this video ages when the time comes, right? BLNK is going to have a bigger squeeze because they have it more fail to delivers. But that depends if they decide to actually cover on that squeeze day, right? There's no timeline for these, so they can cover it now. They can cover it in a year. That's the problem with fail to delivers. They're not very well regulated by our wonderful federal government. So the case scenario is that if both squeeze with fail to delivers, BLNK is going to be the bigger squeeze. However, if they squeeze with regular shares, that really is determined by the amount currently, the free float, and then our possible previous squeezes from $1 to 8, 9-ish. Okay, so let's call it 8, 9, 9. Call it 9. So $1 to 9. That's a 9-time multiplier. Again, looking at this sucker, I'd have to keep track of the shorts on Ortex in order to figure out what exactly happened here, but I really feel like this was just FOMO. So from squeeze to squeeze, again, we're looking at that 212. We're looking at that 212. the increase from squeeze to squeeze, or from point to point, is, let's say, bottom here, about, am I negative? No. I mean, what was the value over here? Low is $1. So yeah, I'll call it $1. 900%. If you get the, if you actually got it at the dollar, right? 900%. If you got it at like $1.18, you'd be 600%. It's amazing how many, a few cents change in that perspective. But then from this bottom to here, about 300%. From this bottom to here. In fact, I would actually consume this, not from here to here, because that wasn't a squeeze. So this was before the squeeze, the FOMO. Yeah, so this should be about what? Yeah, there you go, 600%. I consider anything a short squeeze above 600%. Anything below that, FOMO and option chain. But I can give it a conservative space of about 400%. Right? Those are abnormal numbers. Considering that most stocks grow 10% a year, average, getting 600% in like a few days, you can see that's a little bit abnormal. So like, all right, from here to here, there. Next case is from here. What's going to be a 600% value here? So let's say the bottom here to 600%. We could be looking at about $50 starting point, floor, to potentially $80. So $50 to $80 in the next possible squeeze based on the last low, which was here, and the next squeeze available. Now this would also be, you'd get like the high 80s, maybe even 100 if they cover all their failed to delivers. But if they just do their regular shares on float, I would estimate around the $50, maybe even less. So it really depends on how many people jump in. I can't guarantee anything that I'm saying right now because there's so many variables inside of each event. You cannot just have a repetitive pattern because you have people buying in. You have algorithms looking for a time to get in. You have options being hedged for in the option chain. And then you have hedge funds trying to cover their shorts. So you have 4 possible actions, variables that are unknown in one event, the short squeeze. So there's no way to say how much of either of those possible actions or how much of the actual volume that's moving, right? You can't say, oh, they're all moving equally, so 25% on people buying, 25% on options covering, 25% on algorithms, and 25% on hedge funds covering. You can't say that because every moment in time, there's different values for each one. So if there's a lot more people coming in, you're gonna get up to 1,000 because you have 80% of people buying, 20% trying to cover. By the time they cover everything, the price is probably already up into the stratosphere. So my estimates are somewhat conservative. And when I say 50, I could also be considering a buffer space of 40 on the worst case scenario, right? So FUV is my first watch. BLNK will be the next watch. I'll actually reorganize these here. GOEV would be my next watch, though when I look at it, it's basically cooking itself up very nicely. It's got a bit more to bake in the oven. But why doesn't it just drop down for me? Come on. It's already squeezed. And these are the second, third wave of squeezes. So keep that in mind too. These things have already squeezed. So GOV has a 95% utilization, but I think it was about a 2% minimum and like a 10% max when I saw it last. So this is cooking. Not quite there yet. Remember, we need to see up in the hundreds percent for the cost. Because they can pay 2% of the costs easy. They're banks. These guys are hedge funds. They got trillions of dollars of credit and of assets. So they can figure out how to squeeze that extra money. But when it comes to 100% of a cost that you have to pay back exactly the amount that you've borrowed, plus if it goes to 200%, now you got to cover double you're running into some pretty dangerous long-term territory. So GOEV would be the third one on my list. I would say week by week. I wouldn't give it an exact timeline. So I would say this week is FUV, next week is Blink, the week after is GOEV. BBIG, honestly, I think it's happening now. So yeah, I'm pretty sure it's happening now. Pre-market. Oh wow, yeah. When you see this kind of pre-market activity, $4 in pre-market, I'm not in it. Oh, that's fine. Can't catch them all. But yeah, no. When I looked at BBIG over the weekend, this was a pretty intense one. The size will be questionable, but here's that key again. We don't see the percentage minimums. I'll have to make a secondary video later when we get the data. But 99% utilization, 16 million shorts on loan, not to mention some pretty okay failure to delivers, 7 million here. All combined is about 9 million. Another 5 million, so call it 30 million fail to delivers that they have to be covered. So that's about 46, 50 million shares that need to be covered. It's a low float, so 16 million shares are about 38% of the float. Oh, I just wish I saw these. I would assume, I think I saw these at like 50 over the weekend before they started updating now with the NA. I'm pretty sure this was about 50. Actually, I did some saves. Hold up. I saved some data for my program. Let's see. So BBIG. Oh, what was that name? Vinco. Find next. Vinco, cost to borrow. There it is. Yeah. 70% average. Because they don't give me min, max, and stuff. So it's about 70% cost to borrow. So you know that one's going to pop up very soon. I got this info from Ortex as a exportable file because what can I do? Oh, I can do magic. I can do magic with Excel. I can find all the things that I need with the magical, I don't know, nerd talk. So if I sort these, I sort all of them by cost to borrow, CT, there it is, to largest to smallest, because I don't care about the smallest. We've got Vinco, 71. We've got App H, 28, that's climbing. We've got, I don't know that one. I didn't find this one before. What a treat. And that's how I go through. I can't really take a look at anything, right? Because everything's still updating, NA. But 99% utilization, 10 million shares on loan. What's the fail? Come on, give me some good fail. This could be on the list. But it's not. There's like no fail to deliver here. Okay. So you're looking at 10 million worth of a short squeeze. I mean, AGC, I don't see much potential here. If it had a squeeze, it had a squeeze. This was back in January. That makes sense because there were so many squeezes happening in January. But that's it. And if it was a squeeze, it was 11 to 18, right? That's $6. That's less than 100% squeeze. So it's not even worth this, even though it is high. So the point I'm trying to make here, there's a lot of pieces of data that you need to consider when searching and scalping for squeezes. It's not just, oh, they have a lot of shares they have to loan, right? Or, oh, they have a huge utilization and cost to borrow, right? It's a two-sided die or coin. The first side is how much can it squeeze? The other side is when's the possible next squeeze going to happen? How many days, right? Those are the two. Because if you don't have a big squeeze, but it's going to squeeze tomorrow, is it worth going in? Okay. But if it has a crap load of shares and it's not going to squeeze anytime soon, is it still worth going in right now? Sure. If it's a low price, you see it going down at a very strong support, you can buy a few, you know, average your way up as it goes up after that reversal in trends. But in the overall aspect, if it's going to take a year for that stock to squeeze, there's other focuses available. This is why this is a efficient process. You have to optimize everything. And as a data scientist and a computer scientist, now recently this financial analyst, all of these mechanics of mathematics and efficiency have been like pounding in my head. Is it worth it? Is it going to be soon? Can I order these in the correct manner so I can go from one to the other, to the other, to the other, right? That's the goal. Is when I'm done with FUV, I'm going into Blink. When I'm done with Blink, I'm going into GOV. When I'm going into GOV, I'm going to BBIG. If I can average 7 times the growth process, right? So 7 times my money each time, you can start with $50. And 7 times 50 is 350. Cool. Times 7 again is 2,450. Awesome. 17,000, 120,000, 840,000, and on the 6th squeeze, you're at the millions, bro. So if this timing can be perfected, which life is not perfect, mind you, there's no way to know 100% of what is or will happen, but you can efficiently play your cards, right? All right, so you're going in a squeeze. How do you know when to get out? Ugh, that's a toughie. What I've noticed is pre-market is very interesting when it comes to squeezes. I got out a little bit in pre-market and a little bit during the day when I saw the fall. So I got out at about a $50 pre-market and then around a $37, $40 aftermarket. So I averaged around $45, right? So this is a good average, honestly, considering how far we went again and fell down, right? I don't know about this pre-market happening now with SPRT. I don't. Oh yeah, we're still waiting on data to come back to see how much they've actually shorted and how much are left. Because for all case scenarios, it might not be over. If they couldn't cover a lot during this bump up, then consider that they're still going to keep going up. But in after hours, not a lot of regular folk buy. Right? Remember those 4 pieces? Buyers, option hedges, algorithms, and shorts covering. Well, here there's not a lot of regular people buying, so you can take out FOMO in the after hours. So there's 3 things happening now. Some algorithms have access, but again, some algorithms don't. So this after hours or pre-market area is actually a lot more considerable to be beneficial for institutions because there's less traffic. But with less traffic comes huge growth, because if there's only like 20-30,000 shares being sold, right? And then you decide to buy 5 million of your shorts back, you're going to push that price up. This volume bar itself is 11 million. The previous one was 2 million. The previous one, 155,000. So this was 155,000, 2 million, and then 12 million. So if 2 million can push a price from 28 to 34, 2 million shares can push a price about 20%. 12 million can push a price 100% in a low float manner, right? These are the kind of controlled areas that you can actually depend on, since you know most of the institutions are in the pre-market. So this is majority of institutions. 100% growth for about 11-12 million shares. And support, well, it had a good amount of shares, honestly. Support had not only 20, let's check it out again, but not only 20 million in actual shorts, or 25 million, something around that manner. Let's take a look at support again. Coffee. Okay, they were in 6 million actually. Keep in mind the data is still being updated, right? So they're still estimating about a 6 million amount. Maybe they didn't get the chance to cover. That would be unconsiderable to me. I think they covered something. But they still have another 6 million in failed to delivers. Call it 10 million actually. 12. Call it about 20 million overall in the failed to deliver space, right? So not only do they have 20 million here to cover, they have these 5 million. And if we just saw that 11 million raises the price about 100%, I would imagine, let's call it this way, I would imagine if I was a company, I would say, hey, I cannot cover during the day. Because as soon as I start covering, these goddamn retailers keep starting to buy because they just see the price go up. And as I'm trying to cover, these damn retailers are taking the volume float away from me. So what I'm going to do, I'm going to sneak in during after hours. I'm going to at least test it out to see, right? How much can I cover at once? Right? That's my personal perspective on what happened here, or in many considerations further with what's happening right now with not Blink, BBIG. So look at BBIG again, huge, well, not huge volume per se, but big growth during the day yesterday, a complete upward movement, shorts, options, everything starting to get covered. Here you have 9 million, 15 million, 7 million, 5 million, 5 million. Wow, look at that 5 million bar. That raised it actually up a pretty good amount. Of course, not every percentage and volume of shares will raise the same price at the same time, right? So keep that in mind. These are estimates. So if I say 100% for every 11 million shares, I'm also considering it could be 50% or it could be 150%. But I'm giving myself always a buffer. If I say 100, let's say I personally say the number 100. You may think 100. Boom, done, right? But in a statistician's mind, you're kind of thinking, all right, 100 is the average. I'm always thinking averages. The minimum could be 60. The maximum could be 140. So I'm always playing around the numbers that I'm speaking out loud, not just on those particular numbers directly. That mindset kind of gives you a better perspective and potentially a better awareness and data pattern finding. Because now you're kind of increasing your scope. You're not just looking for hundreds everywhere. You're looking for 60%, or maybe 140 really large percent. This one was 30%. This one was also, I believe, 30%. Okay. But this one was 5, and this one was 14 million, right? 14 million for 30, 5 million for this basically 30 as well. So here's the key. Volume is the key to growth, but not just how many shares, right? It's out of these 5 million, let's call them 5 million volume shares. Where am I looking at? I'm looking in the top left corner underneath Vinco Ventures, BBIG, where it says a VOL volume, 4.822. Call that 5. So out of that 5 million that this bar has experienced, what percentage were buys and what percentages were sells? Now, you're essentially still going to have an equal buy, equal sell, because you need one person to sell to in order to buy, or vice versa. You need a buyer in order to sell to them. You need a seller in order to buy from them, right? So the concept of one-to-one is very much built in to any buy and sell transaction. However, in this moment, as there are sellers being searched, because at some point you don't have sellers, buyers overcome, but you still have somebody willing to sell at a larger value, right? If you bought a coffee at $5 and then somebody came in desperate for coffee, you can sell it for $10. Every person has a price. Consider it that way. So every share has a price also. But as people stop selling, there's buyers in line ready to buy, but there's nobody selling. So then the price increases. Hey, up there, $10 coffee. Are you willing to sell yours for $10? Cool, I'm gonna buy it because why not, right? This is an example. And then the other guy behind me is like, oh, I want a coffee too, but there's no coffee. Hey, you over there, will you sell yours for $11? He's like, sure. Here's my coffee. I bought it for $5. I made $6. Take my coffee, I don't care. That is the price action that we're looking for growing. But not every single one of these candles has that price action. Sometimes there's so many sellers and not enough buyers. So somebody's sweating, trying to get rid of their shares. Sweating, looking for a buyer. Hey, you got to take these shares off of me. Like, they're going to cause me chaos, right? So please, please, please buy these shares. And somebody's like, well, the price is $5, but I guess I'll buy it for $1. And look at that. Just think of that concept, right? A person's always willing to buy something cheap if somebody's desperate to sell. But if somebody's desperate to buy, the price doesn't go up too high because you could get denied. So that's why going up is a slow process, but going down can be literally done in one day. Sellers will get rid of something very quickly, but buyers, looking to buy up, they're not going to go all the way to the guy with $20 coffee. They're going to go look for a guy with $10 coffee, if not $9 coffee, right? They're going to look as much as they can for all possible options to find the best value to buy. But sellers, when they're scared, they don't give a fuck. Whether they're making money from what they have, losing money from what they have. They just want to lose less, so they dump everything. That's why going down is so easy in the stock market and going up is a crawl. Unless you're following short squeezes, right? So BBIG is looking very, very tasty. If I was to imagine that about 20 million shares covered within these two spaces, that would mean, where is it? Arkimoto, not Arkimoto, BBIG. I don't think there was a lot. Let's see. If 20 million covered, they've already covered their shares on float. But there's no way they covered their fare to delivers, because that's already another whopping 20, 30 million, 40 if even. So, but I don't think all of these are covers, right? Because you still have institutions going in. This is a very good point. So what else do we need to know for a very big squeeze? Well, where is it? Wall Street. Simply. There it is. So let's look at BBIG. You need an extra set of eyes, honestly. You need so much information. In order for me to consider that this is actually going to go up further, I have to take a look at what is happening with the ownership of these shares, right? Vinco Ventures. Executive summary, health, cool, highly volatile. Yep, that makes sense. But if I go down to 9.4 insiders, that's not what I'm looking for. Right there. Oh, okay, guys. Okay, guys. This is a big wow moment. I did not expect this. It's the first time I'm looking at BBIG. This is a huge squeeze. It's still going. 64% is being held by the general public, 15% by hedge funds, 12% by insiders, 7% by institutions. So more than half, and this is a night. If you were here with my previous kind of video, if you listen to the whole video, I mentioned that there's like a perfect middle. You don't want general public to own 100%, because who are they going to take money from? Themselves? That's dumb. But you don't want it to be less than 50% because they don't have a lot of power in the holding space. So there's like a middle point where between 50 and 100, there's that perfect space of general public ownership. And I'm thinking it's about 70%, right? So we're close to that 70%. We have plenty of people, institutions and the insiders and hedge funds to mooch the money off of during the squeeze. Plus, we have a good over 50% holding power. That is a big squeeze. So I'm probably going to go all in on this one today because it's showing good signs. It's got great public backing. Let's take a look at the others. Arkimoto. Okay. Oh, I hate scrolling down. There's just so much information. Oh, Archimoto's good too, but it's on the minimum of a squeeze requirement. So general public does own 51%, but it could be better. So you could get a nice squeeze on Archimoto, but BBIG looks very nice. I'm actually going to put this on the top. BBIG right meow. And then Blink. Let's see what Blink is doing. This is one of the most important factors, by the way, is how much is being held by general public. All right, hold up. Let me just do it. This website only lets you do like how many? Like 5 free a month, 5 companies that you can look at free a month, and then 30 if you pay this $7 piece of crap. So, but since this shit's making me money, I don't care how much it costs, to be honest. I mean, I did buy Ortex for $600 a year, so. So let me unlock this sucker. Okay, looks good. Go add that to watch list. So now I have more. I have a couple of more companies I can go through. Or maybe 25. Ownership breakdown. Yeah, see, Blink doesn't have a lot. Institutions, especially institutions, being so comparable to the general public by 9%. The institutions can definitely short it down, but looking at what we had, there was not many shorts left, so they're kind of sitting ducks at the moment. So there is going to be a squeeze, but it may not be as big as we would hope in Blink. Let's see. GOV, let's do Canoe. Oh, I can just click here. Yay. No, Canoe's not going to go too high either. I need a 50%. Oh, wait, that's insiders. General public. Oh, no. Canoe's not going to go too high. Maybe it's going to go to $10, $12, but not much. So, yeah, actually, BBIG is huge. Huge. Which means that I'm going to have to update my traders. So this is the thing, you uncover more and more information as you keep digging deeper and deeper, right? 5-minute chart looks nice. Volume still strong. Oh my goodness, this is going to be a crazy week for BBIG for sure. So that's my recommendation. BBIG right now, this week of August 30th, right? And then we'll keep track of the rest of these and see how and which one would be the next possible. But that's it. That's all I got for this video. Just a little bit of analysis, data handling in the background, getting some ideas. And I mean, like and follow and subscribe if you want to follow these squeeze plays. I'm doing a lot of research based on the backgrounds of each of these companies to find out which one is the next comparable squeeze play. With data, not with just, oh, look, it's doing this thing, it might squeeze. Everyone that I've seen so far only considers the history of the technicals instead of the actual data involved in what a perfect squeeze should look like. So, yep, I'm seeing it. I'm definitely seeing it. We're going to go beyond 9 I mean, we're already beyond 9, to be honest. We're at 9. What? We're at 920. So we're actually right now at the cusp of the previous high. Anyway, I'm going to prepare for this day. Enjoy the rest of yours. Good luck out there in the markets. Stay safe. Only bet money that you're willing to lose. And good luck. Get rich. Change the world. Take the money from the big boys, smart money, quote unquote, and give it back to those in need. Talk to you guys later.